Good evening, everyone. Today is May 14, 2026, session number 7, part number 17. So we are covering the UAE Corporate Tax and the topic is the computation of the corporate tax. And the corporate tax is the link with the what is taxed. So it means the income. So this the area where we are. So we started with the computation of corporate tax. This is the second out of 8 adjustment we gonna study. In the previous part, the Article 33, we learned that is the first adjustment. Under that, we covered the 12 item. So now this is the second adjustment, less the exempt income. So there will be primarily is the 4 deductible items. So one will be the dividend and the gain on local and international. So let's see that in terms of the exempt income, this is our topic of the exempt income. Which article of the city law is 22? So mostly Abdullah is focusing and he's concerned about the law, which article, but I think Abdullah is not there today. Okay, so here we are seeing that under the Article 22, the local dividend from the UE company, we don't have to test the is meeting the 5% or not meeting the 5%. Then second is the participation exemption. The participation exemption, we have to focus on the test that we have to see is investment we did 5% or more, or the 4 million applicable on the 4 items. So that we're gonna see over here. Here we are just initially we are covering which are the element under the exempt income we have to discuss in this session. Next is the foreign permanent establishment that normally we are familiar with the name of branch. So here the relevant article is 24. Next is the international transportation by non-resident. Here the important is the non-resident. As we said, under the exempt income, there is a 4 deductible item. So these are the 4. Now let's understand the each item. The local dividend we said is already covered. The dividend income. So dividend income come from the local companies, not applicable. Why? Because here we said is all good to go. So under that, how about the foreign dividend? Yes, participating interest will be applicable on the foreign because local is already covered over here. But again, on each point, wherever the local is coming, we are reflecting over under this as a exempt. We don't have to test this. But foreign dividends, we have to see the foreign subsidiary company paid dividend to the UE company. And if it's meeting the 5% shareholding in a 4 million is exempt, is meeting the participating. Then the next is the either is a dividend or either we sold the shares, capital gain. Again, the capital gain from the local company, it will be exempt without the PI test. But if the dividend is coming from the foreign company, okay, the foreign company, so foreign capital gain or losses on sale of shares, if it's meeting the PI criteria, subject to meeting the criteria, is exempt. Then next, foreign exchange gain losses. If we made the investment, this is the impairment testing almost. If the impairment testing, if this PI criteria is met, so it will be also exempt. Impairment gain and losses. This is the foreign exchange gain and losses, translation of the currency. Okay. Here the impairment gain and loss. This is the value of the shares. We will discuss this in the IFRS 9 where they're saying how the impairment test will be applicable. If it is a impairment, a decrease in value of the shares, and this is the, like we have the AD, we buy the shares in the pound. Okay. So at the year end, we will retranslate exchange gain loss sorry, the retranslate in AED for reporting purpose. So this is the foreign exchange gain loss on the value. And this is the share value itself is affected, impairment gain and loss, investment uh, impairment test. So this is the basic difference over here. Next, we have the foreign permanent establishment. Foreign permanent establishment, we are familiar with the name of branch, and the under branch, we have the option to make an election. If the election is made or not made, our treatment will be differ based on that. Foreign investment, what benefit to be have elections? Subsidiary will not give you the profit. Okay. Subsidiary giving the dividend. Okay. From subsidiary, we will get the dividend, rental income. Okay. From subsidiary, these three, four, five dividend, rental income, interest income, royalty income, management fee. This is normally we are getting from the subsidiary. But here, what we are discussing the branch, foreign permanent establishment. So they will give us the profit. Okay. They will give us the profit. Do not include PE profit in UE. Why? Because we already took the election. Election, we said we will not pay the tax or we will not add the foreign branches into UAE. This is the option is given. But this option, if we choose for all the branches, okay. So if we did not opt this election, if we did not opt this election, then we have to add this profit into UE. Add profit loss in the UECT computation. Why? This election. This election is very important, and we seen in the previous session also how to make the election. But moving forward, we stand alone have this election topic, and that required maybe 3 to 4 hours session to understand the election. Because with the example, practical example, we will cover that. Okay, so normally in terms of the easy understanding, routine life, what is the election? I'll just give you one of the example as a from the our routine life. Okay, in routine, we are familiar with the marriage contract. What is a marriage contract? So if we married, so there is the additional liabilities. Additional liability part will be add on. This is the election. What's the election? If person choose to get married, so this is he said yes. If person choose not to get married, so he not opt for election. So if he, so here is a plus and minus on both sides. So he's when the parents ask his kid, okay, you want to get married, or he taken the decision he will not go for marriage, okay, which means he opt the election. This is one of the election. He choose his pathway. I will not gonna marry. Okay, this is his pathway. So no additional liability. No additional liability. If we choose to get married, so additional liability will be added on. This is the basic understanding what I'm saying. What is the election? If we say yes, there's a different circumstance implication, consequences. If we say no, there is a different consequences. So this is the basic and routine life. I choose to get married. I chosen to get married 10 years before almost. So now, mashallah, I have 3 kids. So this is the if I choose yes at the election, get married, so I have 3 kids. So versus the person who not chosen to get married, he don't have any kids. So no additional liabilities. What the liabilities mean? Additional reporting. Additional reporting. While the election, each election have the further implication. And this is the basic point I try to highlight and share the concept. What is the election? Okay, now the next part is international transportation. Okay, the international transportation, here the important part is non-resident. Here is the important part is non-resident. Non-resident here, our learning is that if British Airline operate in UK and as well as here. So versus the Emirates Airline. I think we learned the example reciprocity basis. Uh, that was the example. We said, okay, if we invited by somebody on kid's birthday, so we will take the gift if one of my friends, AB, invite us on his kid's birthday, we will take the gift and cake, some toys for his kid. So for the same, my wife is saying, okay, now we have our kid birthday. So I said, okay, we can buy the toys for kids. So what my wife is saying, okay, we went to one of your friend AB, okay, on his kid's birthday. We took the gift for his kid. Now they will bring gift for our kid. Now they will bring gift for our kids. So this is the reciprocity principle. If we give them the gift, now we are expecting them bring the gift. Again, the matching concept, just for understanding. So this is the reciprocity principle. What is the reciprocity principle over here? Non-resident, the first condition is not for UE company. It's non-resident, it's not for UAE company. Is for the non-resident means UK. If British Airline operate in UAE, operate an Emirates Airline. What you is saying, if UK will not charge tax to them while our flight's going to UK, if no tax, so UE will not charge any no tax to British Airline. British Airline in UAE non-resident. But they're saying reciprocity. If our airline going to UK and they will not charge the tax, so we will not charge the tax to them. No tax, no tax. If they apply the tax, let's take another example. Here is the USA. Okay. And we can say the US airline. If Emirates Airline go here, they will say pay 20% tax. So, okay. So same UE will say to their airline pay the tax. One of the classic example for this currently the United States of America, the President Trump is in China in his official visit to China. So we seen from last 1 year the tariff. So US or the President Trump, they applied tariff on Chinese product. Let's say they said, okay, US saying whatever the product coming from China is 30% tax. 30% tax. So what China said? They said from our side also is 30%. US applying the tariff, the custom duty on their product import into the US So China applied the same tariff on their product also. This is one of the classic example where the reciprocity principle is there. I'm not sure if somebody seen this visit of the Trump in the China. Um, mostly along with him, the business owners are there. Mostly the worldwide business owners are there with him. Anyhow, this is not our topic. The basic principle, hope you understand over here. These are the additional notes we covered in the previous slide. So again, it's coming over here. And this is the importance of the exempt income. Importance of the exempt income. On May 13 FTA. This is the FTA. They arrange one online webinar. This is slides from there. So this is the new legislation on that, on participating exemption that we are discussing. So they have the new decision in which the new changes are there. So this is the very interesting and the comprehensive topic. So of course we will cover so here the key requirement, here is the update. 5% or greater ownership, no change in new law. Held or intend to hold the participation for the uninterrupted period of 12 months. These are the additional conditions. Along with that, no change. Subject to corporate tax at statutory 9%. Okay. Maybe effective rate, even here, the effective rate sometimes 6.5, but the statutory rate is in UE 9. They're saying in the other part of the world, statutory rate is 9% or above. So even effective rate is coming is lower, is good. Okay, is good. Still the exemption is, the criteria is met. This is one of the condition. Entitle the holder to at least 5% of the, no change, same condition is there. 50% or less asset of the participation. Okay, only applies to the participating where related party. Okay, so they mention, okay, this test only applicable where the related parties are there. Now alternative to 1 and 4. This is the 1 and 4. Historical acquisition cost of the ownership is 4 million or greater. Substitute all with the 5% substitute all the 5% requirement. So what is saying, if we met this 4 million threshold, so now they enhance or they add, they said, okay, these tests are met. This requirement and this requirement, if this historical test is met, then we don't need to focus on here. Anyhow, we'll cover once we come on this topic standalone, but these are the few examples that I want to share in the new legislation is that they added few amendments. Okay, so this we covered the 4 items. This we covered. Okay, this we covered. Okay, so now the exempt income. Okay, the exempt income. This one, election, foreign permanent establishment, foreign branch. Election is made or not made. Okay. So this is the written screenshot. We have to say yes. This is same like I said, the marriage contract. We will say yes. The further window will be open. If we say no, further window will be open. If we choose yes, so in accounting schedule, these figures we have to add. Dividend profit distribution received from UE resident person, we have to add over there. Okay. Income and loss from the participating interest, taxable income and loss from the permanent establishment. If we say no, okay, we have to add this. If we saying yes, this will not be appearing. This will not be appearing. This yes or no will increase or decrease our compliance in the city return. And of course, what are the additional compliances on taxable person? It might add the value or it might be reduce your work. Okay, election made or not made. So we already discussed do not include PE in yes. If we know, then we have to include. Okay, so now we have 15 minutes. Let's cover now the same aids adjustment we covered so far two. Okay, we covered two. This is the third intra-group transaction and eliminate if you are a part of the group. What is the intra-group? Related party. Related party under the same ownership, group ownership, company A, company B. So if we are doing the transaction, so that we have to eliminate if you are elected as a or applied tax group. What is the condition? 95% shareholding. Then we can make the tax group. We have to eliminate under the tax group. This is one of the additional. Okay, let's see the next transaction with related party and connected person. This is the transaction, the same earlier we discussed the exemption example, but now the definition of related party. If related party, if we have 50% or more ownership, common ownership, that company will be our related party. So all the sale and purchase with them at arm length. Arm length. What is the arm length? Market value. If we are selling to the third party, if we are selling to third party at 100, so the related party we also sell at 100. This is the arm length. But normally what happen? We are saying, okay, this is our system concern. Give him on 80. So they're saying, no, this is not allowed. This is not allowed. This is not at ALP. ALP means whatever the price you are giving to third party, the same price you have to sell on that. But there is another word is connected person. Connected person. Connected person like the owner, like the director. Okay. And the connected person definition, the word director, FTA given one public clarification also. The word director, if you have the visa designation as a director, that is not coming under connected person. This is one of the basic point. They're saying director, if he have the control of that organization, if he is member of the board of directors, board of directors. What does that mean? Just getting the visa and is not subject to the connected person. Plus other condition we have to test on that. If he's controlling that entity, is affecting the decision making of the entity, then it's coming under the connected person. And the connected person up to fourth degree. Fourth degree up, fourth degree down, left, right. What does that mean? First degree, father or the parent. Here, the kids. Here, the grandfather. Okay, the grandkids. Then continue up to fourth degree. So all the connected person, wife side and the father side, cousin, auntie, everything will be up to fourth degree. It will become under connected person. So anyhow, so these are the core concept for this. So which article is dealing? Article 37 dealing with the related party. Okay, the next is the unrealized gain and losses if election is made. if election is made. I believe we can stop over here because it will take more time. We have to take some example with the unrealized gain and losses. Only 10 minutes is left. We might not able to cover this. So we can start on Sunday from this election part. So any questions so far? Most welcome.